All right, our last section in Chapter 18 has to do with acquiring additional capital. And what this chapter is going to talk about is essentially financial leverage and some of the things that go on behind the scenes to make sure that when we take on additional debt that we're doing so in a smart way. So let's talk about that a little bit. When it comes to making financial decisions, how a business chooses to obtain funds for expansion or development is obviously going to impact its earnings or how it chooses to make money. So each method has different impacts on earnings. For example, if you borrow money, like do short term or long term debt financing, that is obviously going to increase your interest expense. On the other hand, if you choose to issue stock, that may result in you making dividend payments. So there are pluses and minuses to each different kind of financing decision. And what you have to do as a business is choose which one is going to make the most sense for your company. So what we look at is something called the cost of capital, and that's the ratio of interest and dividend payments to the proceeds from debt and capital financing. We refer to that as the cost of capital. So essentially what that means is that if a, a business should only raise their capital if the projected increase in earnings is greater than the cost of capital. So what that's saying is you want to be able to make more money than it's going to cost you to obtain that capital. If that's the other way around, then it's not a very smart financial decision for you as a business to do. So we've talked about the following ways to raise capital in this chapter. We could do a line of credit, we could do a note payable, we could do bonds, we can do common stock, and we can do preferred stock. So there's lots of different options to look at when you're talking about making or raising capital. So these are the factors that need to be considered when you are making the decision of which capital raising decision should I make. That is your interest rate. How is it going to impact your earnings? The repayment terms, the ownership control. So how much do you as the ownership or as the owner have control over the financial decision? And then obviously the debt ratio. I would highly recommend that you make sure to read page 569 in your book to go over these 5 things in more detail because I could have added an extra 20 slides to this presentation and I chose not to. Instead, I'm telling you that there will definitely be questions on the test, probably true, false, and multiple choice questions related to these 5 things. So you want to make sure you go back and read through those. So what I mentioned earlier is something called financial leverage, and that's the ability of a business to use borrowed funds to increase its earnings. And obviously, you want to be able to increase your earnings for more than it costs you to borrow the funds. If it costs you more to borrow funds than you're going to make, that doesn't make sense. So, like it says here, the borrowed funds must be invested in the business, increase it by more than the interest they're going to have to pay. So one way you can figure this out is by taking your operating income. And so saying if you can increase your operating income by $4,000 or $5,000 or $6,000, so on and so forth, and your interest expense is going to be $3,200, okay? Then you take your net income that you're going to receive from this. So if your operating income is 4, it costs you $3,200. Obviously, you have an income of $800. Plus, that's going to be taxed. So the difference then we subtract out the tax, okay, is 600. Your investment that we were asking for, the borrowed fund, is $10,000. So when you take 600 divided by 10, you get a 6%. So that's what we're talking about here is you have to determine if you can make an extra 4,000, then that's a 6% return on your investment. However, if you can only make a $3,000 increase in your operating income, but it's going to cost you $3,200 in interest expense, then you're at a negative 1.5. And obviously we wouldn't want to do that. That doesn't make financial sense for us. So when it comes to selecting your finance method, we need to make sure that we take advantage of financial leverage because we cannot risk having too much debt. That definitely does not look good when we're looking to attract investors, as if we have too much debt. But with that being said, it's very hard to determine what exactly is the right amount of capital that should be raised by debt versus by equity. So it's a very fine line. And so on my next slide here, I'm going to show you a schedule that the board of directors of your corporation typically would use in order to guide your decision making. So what this looks like here is we take our financial statement balances. So here we have our lines of credit, we've got a note payable, we got a bond payable, and then we just might have some other liabilities that might be like accounts payable that we owe for a total liability of $181,000, which means that when we add all of those up, our debt financing is equal to this amount. Then we have our stockholders' equity down here, okay, of 190,000. So our equity financing is 162. So this then, what this is doing then is saying that if we had a line of credit of 4,200 and we added 18,000 to that, our new balance in our line of credit would be 32. Same thing as if we had a note payable of 50,000 and we asked for another 160, we'd be at 210. Okay, if we took out another $162,000 in equity financing, we'd end up with a total stockholders equity of 352. So that brings our amounts from 371 all the way up to $711,000. Okay, so we're making a pretty big jump there. So right now, if we take this 190,000, or excuse me, 181,000 divided by the 371, that's where we're getting the 48.8% for a debt ratio. Okay. If we do those numbers that we talked about up here, it would raise our debt ratio to 50.5. And then we would have to decide, is that too much compared to right now? We have 53.3% of our capital coming from equity financing, meaning stocks. If we did that, it would bring that down to 52.4, but our debt would go up to 50.5. So we would have to make that decision. Is that a comfortable ratio for us to be at for our business? If not, what is? And so it's very delicate. It's not, there is no cookie cutter answer because it all depends on what kind of business you have, how receptive are your investors, how good are you at handling your debt versus your equity. So lots of questions to consider when you're going to select which financing method is best for you. So we're actually going to take a look at this as we do our 18.4 work together. So we'll head over there right now.